Welcome to the 7 Investment Management Global Market Update for the first quarter of 2019. My name's Martyn Surguy, I'm the CIO. I'm joined by my colleague and Chief Strategist, Terence Moll. And over the next 4 minutes or so, we're going to be running through our latest views on markets and strategy. So Terence, the last quarter of last year really did seem that the investment environment had changed. What do you think is going on?
It's been a really tough time for investors. Most of the world's major global equity markets were down by between 10 and 15% in the fourth quarter. In fact, it's been the worst time for global equity investors since the third quarter of 2011.
It looks to me as though investor sentiment has absolutely collapsed, in some cases to levels not seen since 2008. But if I cast my mind back relatively recently to the summer months, and it seemed that everything was fine. Investors seemed much more relaxed. The world economy was slowing a little bit, but certainly not very dramatically. Inflation was ticking up, but not very dramatically. And now you only have to open the newspapers to read about, a recession in the States is imminent, China is slowing very sharply, and there's disappointments pretty much everywhere around Europe.
Yes, the really curious thing is that the actual growth numbers haven't really changed very much. My favorite example is from the United States, where the New York Federal Reserve Bank produces forecasts of GDP growth using all the latest economic numbers. And what they found is that since early October, their forecast of US growth has varied between 2.4 and 2.8%, which is in a fairly narrow range.
So you think that investors are too pessimistic at the moment?
Yes, definitely. And some markets now are beginning to look downright cheap, including parts of the US and Europe, and some emerging markets for that matter. Strikes me that this is a time to buy decent quality assets at good prices. Don't you think it feels a bit like the beginning of 2016?
I think that's a really good analogy, because back then, if we cast our minds back, Chinese growth seemed to be wobbling, oil prices had collapsed, the US had already begun to start increasing interest rates, and then within 6 months' time, the economy seemed to be back on track, oil prices had recovered, and there seemed to be a much better mood around markets. I suppose the difference between now is that we've now had something like 8 increases in interest rates, and there is some concern that the Fed might be in the middle of a policy mistake or a policy error.
Yes, that's very true. But still, in real terms, in other words, after inflation, US rates are still only about 0.5%, which is pretty low. It doesn't strike me as being exactly crippling. Strikes me that this is the levels at which equities are still a pretty good buy.
I very much agree with you, Terence, which leads us to current strategy. How do you think investors should be positioned right now?
Well, if I look at our portfolios at the moment, we are overweight equities with a bias towards the United States. Basically, we think that the equity sell-off has gone much too far. We are underweight bonds because we think in an environment of interest rates drifting up across the world, we think many bond investors are likely to lose money. And finally, we are somewhat overweight sterling because we think that sterling is very cheap by long-term standards, and we think some kind of resolution will be reached on Brexit that is not too negative for the United Kingdom.
I very much agree, and I think as part of a sensible long-term strategy, those tactical tilts make a great deal of sense to me. I hope you found that brief canter through markets and strategy useful, and we look forward to keeping you much more fully informed over the course of the next weeks and months.